Welcome to the new episode of Brave New Edge. I'm your host, Nikola Legetic, and my co-host, Zoranka Desnica, is along with me. Today, we have a special guest, Bridgeway Capital Management. We have two members of the team. We have Seema Ackerman, who's the head of marketing and distribution, and we have Jakob Pozharny, who is the portfolio manager and chief investment officer, co-chief investment officer. Bridgeway is unique in a way that their focus is on their approach to investing is systematic application of fundamental analysis, and we'll dig into that and what that actually means. Welcome, guys.
Thank you.
Good to be here.
Of course. Let's just start off with an introduction. Seema, maybe you can kick it off. You're new to Bridgeway Capital Management, and
Sure.
touch on that, and we'll take it to Jacob.
Okay, I'm happy to do that. Thank you both for having us. We appreciate it. As you noted, I am relatively new to Bridgeway. I started at the beginning of this year. Been in the investment industry for 22 years and have worked generally at very large financial institutions. So Bridgeway is the first time I've worked at a smaller privately held asset manager, and it has been a wonderful experience.
Excellent. Jacob, you've been in the industry for 3 decades, so
Yeah,
you
I've
can.
been around. I started at Bridgeway in 2018. I was tasked with building out the international, global, and absolute return capabilities to diversify their close to 25 years of experience in managing U.S. long-only strategies.
Excellent. So, like we said before, it's a fairly unique mandate. So, can you maybe walk us through, the nature of the process that the investment team undergoes, or particularly international, global, and absolute return?
Sure. So we divide the process into two distinct elements that complement each other. The first is stock selection, and the second is portfolio construction. We spend half of our time focused on stock selection in terms of application and research, and the other half on portfolio construction, research, and application. I think what makes us unique in terms of the stock selection side is we have a contextual stock selection in applying systematic fundamental analysis. So what that means for us is that we spend a lot of time figuring out why it is that fundamental management doesn't work as well in terms of stock picking in the areas of new economy industries, in areas where intangible capital is really driving overall firm assets. And we've spent research publications explaining our views on this. What motivated us when I came in is recognizing that basic valuation techniques, basic quality metrics, they really fall apart when you're trying to pick stocks in new economy industries like biotech, like semiconductors, hardware, software, media, are industries that are really driven by intangible capital, and intangible capital intensity is really high in new economy industries. We find that systematic fundamental analysis, discounted cash flow modeling, works quite well in the old economy industries, like transports, like utilities. There you can really make sense of the financial statements, in that those financial statements are predictive of what's happening in the stock market. So we contextualize our stock selection process based on industry. We spent a lot more time applying sentiment analysis in the high intangible new economy industries, and we're much more focused on fundamental stock picking for the old economy industries. That's, I think, an element that really differentiates our process in terms of stock selection. And there's a variety of things that we do on the portfolio construction side that I think are also quite unique, and really drive a return stream that's highly differentiated from competitors and definitely differentiated from the market direction.
No, definitely, and that's you read my mind. I mean, that's usually we ask, was the number one differentiator. So when you talk to consultants or clients, they love to put people in buckets. Like, okay, this is large cap value. This is, international quant, or this is, where do you kind of sit on that, Venn diagram of quant and fundamental, somewhere like in the middle, we say more quant, more fundamental.
I mean, that's kind of a difficult question to answer. My experience has been that an allocator has a specific RFP out with a specific mandate, and that mandate is beat US small cap value, or beat the MSCI emerging market all cap index, or we need an absolute return strategy that's uncorrelated to the overall market. So we're able to build strategies based on mandates. I don't think we're trying to describe ourselves as pure quant, or we're trying to describe ourselves as fundamental. We're an organization that takes a mandate, understands the tracking error, and remains style pure to that mandate, picking portfolios with varying degrees of holding. Some of our portfolios have around 100 names. Some of our portfolios have 250 names. We have an absolute return hedge fund product that does longs and shorts in more than 35 countries. And there we're holding about 250 long positions and 300 short positions.
Interesting. There's I think the word quantamental is becoming more and more popular, or I would say pronounced over the last is I don't, again, without putting any name, but is that how we can maybe synergize the two?
I've heard that phrase before. It's unclear to me what that means. We spend a lot of our time looking at financial statements. We look at income statements. We look at balance sheets. We grab income statements and balance sheets from 10,000 companies all over the world. We try to figure out what stock selection metrics are most effective on an industry by industry basis. And then we apply those metrics systematically, recognizing that there's obviously going to be assumptions that we take on in any of these stock screens. We see these as stock screens that are effective on an industry by industry basis. But with any stock screen, as you know, given your background, there's certain assumptions that are in play. A stock screen can't be applied blindly to an industry that has been affected by tariffs, or it's been affected by government regulations, or in situations where a stock is defined as a meme stock, where fundamentals are completely irrelevant. So in situations like that, we recognize the assumptions of the stock screens are contextual in nature and based on intangible capital intensity, and then we make adjustments. I would say that 85% of our process is systematic, 15% is discretionary, but, and this is a big but, in terms of my time, in terms of the time of the portfolio management team, 85% of our time is actually focused on that discretionary component. Running a screen is very easy. Understanding the assumptions of the screen, that's where the challenge is. So we run these screens, and then that's fairly automated. But once we run these screens, we have a investment analyst or portfolio manager go through and grade the stocks based on that screen. So we like to long the A stocks, we like to short the F stocks in our hedge fund-like product. And in our long-only product, we primarily invest in A or perhaps B stock based on our grading process.
So the universe has to be, a couple of thousand names, right, to get to 100 or 250, right? Is that
So it depends again on the mandate, right? So in our global opportunities strategy, what we do is we screen through 10,000 stocks in more than 35 countries. We also have an emerging market small cap strategy where we're very style pure. So we are benchmarked to the MSCI emerging market small cap benchmark that has about 1,900 names. And thereby our investment universe is roughly 1900 names. We try to be style pure. So if we're investing relative to the emerging market small cap benchmark, the implication is that we try to stay pure to that investment style and invest only in those stocks. So again, the number, our investment universe is very much defined and restricted by the mandate that the client chooses.
Understood.
What's coming out here, if I may, is sort of the benefit, right, of being a boutique asset manager. What you're hearing is it depends and we'll customize. And that is really the strength that we have at Bridgeway. And that you can't necessarily categorize us like you started out with, how does the investment consultant community look at you? It's really specific to the mandate. And we can really evolve our process as well, depending on the client's, what their goals are.
Right. This
So
is so your clientele is mostly institutional, right? I'm assuming.
no, actually, we are split. So we certainly have an institutional client base, but we also work very closely with the intermediary market. So your wealth management firms, your RIA firms, where there's a really nice appetite, frankly, for negative correlation type strategies to be implemented in client portfolios. So certainly we're not just on the institutional side.
Yeah, no, but when Yaku said that, you know, there's an RFP and solve for this, that's not
Yes.
just sounded more like institutional but I also see that, people are offering more exotic elements, whether it's, you can, buy a private equity now in your 401k. But so I know the wirehouses and the intermediaries are also opening up to the probably the products like yours more. So
Yeah, your family offices, multifamily offices. There's been a huge, a lot of wealth a lot of sophisticated wealth, frankly, that has moved into that space, and it's not, doesn't use an RFP process necessarily to find managers.
understood. Yeah, so let me just, continue. Just ask you a couple more things, Seema. When you go inside the room, when it's whether it's meeting a new prospect or something, like what are some of the things after the fact that you hear from them? What are some of the customer feedback, right? Like
Yeah.
you definitely try to source it somehow, right? So what we always like to see, like, what do clients say about Bridgeway Capital Management? What's so unique? I know you have this whole, the philanthropic commitment. That
We
you have,
do.
other things that are definitely unique. Ultimately, nobody's gonna. I mean, people will pay attention to that if the numbers are good. If the numbers are bad, like, oh, this thing's gonna go on the wayside, right? It's always like that. Like you can have all this interesting stuff on the side, but as long as you're performing, is that? Can
Yes.
you tell us a little bit about that?
Yeah, sure. And for lucky for us, and the strategies Jacob's referring to, the numbers are good. So it definitely does help us. Listen, there's a lot of things that are interesting to clients about Bridgeway. Number one, and not to be understated, is we're a privately held company. So that's very, very different than having a large asset manager that has to answer to public shareholders, that it's in several different businesses, investment banking, trading, and asset management, where they have a public shareholders and they have to answer to the street every single quarter and they have to do something interesting to make that business look good. We don't have that, right? We are for just over $4 billion firm with 30 partners. All of us have a private ownership in the business, so we are wholly aligned with the client. In addition to that, we do invest our own balance sheet capital into these strategies. So we are sitting next to our clients as investors in all of the different areas that we'll talk about today. So that's really not a small thing. When you look at the world's largest asset managers, very few of them can say that. Clients love that about Bridgeway. You mentioned the foundation, so I just want to be clear on that too. The Bridgeway Foundation, which is affiliated with our firm, is actually been there since the sort of the starting of Bridgeway Capital Management, and so that's not something new that we decided to do when the world decided to focus in this area and it got popular. It's in the very ethos of what we do. So myself, Yakov, everybody that works here is very philosophically aligned with, at the end of the day, after we have our net profits, what can we do with some of that capital? As partners, we put a portion of that capital into the foundation to help better the world, and whatever, the foundation is large and has a lot of different mandates, but that's very much core in what we do as an asset management firm. Also incredibly unique. I'm actually not sure of another firm that's set up in that way on
No,
the philanthropic.
definitely. Yeah, me. It's my first time, so I mean, just you always trying to think of what this thing reminds you of, like in terms of other firms you spoke to, but no, it's definitely very unique, and there's always a market for that for sure.
Yes.
I want to just touch on something, Jakub, that you said earlier, that that the fundamental stock picking has difficulty selecting new economy companies. How much is regime in which the market is relevant to that comment? Because, like, everybody was putting these, price to sales multiple on software names in 2020, 2021. And then all of a sudden, the rates went up and everybody focused on the cash flow, which is the fundamental kind of underpinning of picking stocks, right? So I feel like those new economy names really were valued or observed through a different prism during that period. Is that something that matters for you, the regime in which the market is in currently?
So when we build out our screens that are industry specific, we want to make sure that they function not just over a couple of years, but they function over decades. They function across geographies. They function and add value across different accounting standards as we move from one country to another. It's something that we definitely need to consider. We want to make sure they work in up, down, and sideways markets because investors don't like to hear, well, I'm sorry, we underperformed because the particular 6 months didn't agree with us. They want to have a stable and consistent, repeatable alpha, excess returns relative to a long only benchmark, or consistency of returns, high Sharpe ratio in the hedge fund space. So when we do our research, we want to make sure that the research can be applied over different types of regimes rather than specific types of regimes. It's one way of answering your question. A second part that I think is important is that the research that we've done on intangible capital intensity and contextual stock selection, this is not stuff that's, particularly, it's not new. There's accounting professors have been talking about this, writing about this for decades before we published our work in the Financial Analyst Journal, in the Journal of Portfolio Management, in the Journal of Investing, dozens of other publications that preceded us that motivated a lot of our thinking. What we're trying to solve for here is recognizing that value-based metrics, value-based screens, quality-based screens, they've really degraded in their efficacy since the 2008, 2009 period, since the GFC. So what we're trying to do, and this is kind of echoing the work that motivated us in the book published by Baruch Lev called End of Accounting. He actually got me into this area of research and made me think deeply as to why it is that these particular screens have kind of fallen apart. Recognizing why these have fallen apart is the key to building out a contextual stock selection process.
I am going to pass it on to Zoranka because I'm sure she has the way better questions than I do. This is like the meat of the podcast is the use of technologies in the process. So I'm going to hand it over. Go ahead, Zoranka.
Yeah, so I was, very interested when you mentioned NLP techniques that are you using. So basically, can you just say your point of view from, going in spot textual data? How do you extract them? Are you using this kind of new NLP technologies that are all around us?
This is actually our newest area of research. It's a great question and very relevant for what's happening right now in the marketplace. We actually have a paper coming out this month in the Journal of Portfolio Management that has outlined our thinking and our research in this area. In this paper, what we've done is we've actually shown that textual analysis is additive to financial statement analysis. What's most interesting for me as a conclusion of this research is that you can apply different types of screens. And the question is, if you apply textual analysis, does that add value to these screens? And in this paper, we actually show that it is often uncorrelated to the cross-section of quantitative screening metrics. So we do believe that textual analysis is very important. We've actually partnered with a couple of academics in this field using Computext. This is a new data set that practically none of our competitors have. Very fortunate to partner with academics who've actually developed this data set. And what's unique about this data set is that rather than just throwing the kitchen sink at an LLM and trying to understand what it is that the LLM is telling you about earnings calls or regulatory filings, what this data set allows us to do is take apart the earnings call, take apart the regulatory filing into sentence by sentence extractions from the underlying document and group it into different types of segments aligned with the accounting taxonomy. So, for example, we can pull information on the topic of revenue. For example, we can pull information on the topic of earnings, backlog, tariffs, intangibles, which are so critical to our own stock selection analysis. And what this data set provides is a sentence by sentence extraction categorized by topic with a specific sentiment assigned to it based on work that the accountants, the PhD accountants, have actually put into place. So the data set is just a whole bunch of sentences with timestamps, with different topics, with specific sentiment based on the judgment of these accounting professors. Now, as an extension of that research, what we've done is we've applied our own techniques to understanding if these types of sentiment assignments make sense. And we actually find that not only do they make sense, not only do they add value at a modest Sharpe ratio, but definitely a very additive Sharpe ratio. I know there's folks out there from the University of Chicago, for example, that argued that you can throw textual analysis into like LLM platforms and get just phenomenally more predictive results. And they're claiming batting average of 64%. Others have done that as well. I didn't believe that publication when I was listening to it at different conferences. It was actually disproved, and we can talk about how it was disproved. We're working with Sharpe ratios of around 0.7 to 1.1 in terms of doing textual analysis, and this is published in the Journal of Portfolio Management Research. But what I'm most excited about in terms of the result is the screening methods based on textual analysis appear to be orthogonal, uncorrelated to like price to book screens or price to earnings screens or price to cash flow screens. So what CFOs, what CEOs are saying about cash flows adds value, adds color to the underlying screen on price to cash flow, for example. That's what's most interesting to me as an empiricist and also co-CIO at Bridgeway.
Oh, great. Thank you. Thank you so much for this great insight. So basically, can you tell me a little bit more about the technology that is all of this aligned on? Basically, infrastructure.
Analysis, or are we talking about the textual analysis? So this is the data set is called Computext. I think you can find more details on their website. And the data set is a bunch of sentences. So the data frame has multiple columns. The data frame has a timestamp column, and it also has a sentence column, as well as a sentiment column. You also have a topic that's being discussed in that sentence. There are, I think, about 40 different topics in that sentence. And they range, as I mentioned, from earnings to cash flow to backlog to inventory to tariffs. So you can screen on a particular ticker on a particular topic and understand what the sentiments of that particular sentence is. We find that that's very additive to the overall stock selection process in this Journal of Portfolio Management publication.
So it's structured textual data, right? It's not just like a bunch of text being dumped into, like you said, an LLM. It's more, it's in a data frame, like you said. There's
Correct.
columns. Yeah. Okay.
That's
Got it.
correct. I like the fact that we're using a structured accounting taxonomy in this research. So, accounting taxonomy has been well defined for hundreds of years, but it hasn't really been applied to textual analysis. And that's what this research has focused on, the application of textual analysis to a particular accounting taxonomy. What motivated us to look at this is I went to an accounting conference a couple of years back, and there were a bunch of young professors from the University of Chicago showing that if they just throw financial statements at an LLM, the LLM, and I think they were using ChatGPT at this point, can very effectively forecast whether the stock is going to go up or down with a batting average of close to 65%. And it was very hard to believe. There were lots of questions, but these were very reputable professors. 6 months after they presented this, there were another group of accounting professors at the University of Chicago that took the financial statements that were thrown at the LLM, adjusted the financial statements by a penny. Basically, if the earnings were like 50 million, now the earnings are 50 million and 1 penny. And they applied the same techniques because they were at the same university, at the same code. And they found that this tiny perturbation in the financial statements changed the result dramatically. The implication here is that data mining is extremely easy to do with an LLM. We have point in time data sets, as you know, but we don't have point in time LLM techniques.
Exactly.
So this is a way to get at trying to create a structure based on traditional accounting taxonomy of looking at sentences and making sense of sentence by sentence implication in terms of sentence.
Oh, great.
Probably, Zoran, this is the last one because it's just so fascinating. Is there any difference in strength of signal between domestic and international stocks companies?
Well, absolutely.
Okay.
Quick answer is the less efficient the market, the more the stock selection opportunity in that market. So, in very general terms, if you take a look at the S&P 500 names, they're very, very efficient. You can pull off some predictive value, but if you look at the least efficient equity space in emerging markets, small cap, for example, there's a 6 to 8 times more stock selection power in emerging market small cap compared to the S&P 500 names. So definitely the answer is yes. And this is the same for textual analysis and for looking at financial statement screens.
And I also think that like I covered international and global and emerging markets as well in the past, and it's just getting the transcripts, or even not all of them are also in English, right? And so a large cap U.S. company has earnings call. Everybody's on it. It's on TV. It's just like disseminated. But I also think the gathering of that stuff is also probably somewhat of a challenge. So by default, less people are going to have access to it, and he's going to have more. Am I getting some?
Absolutely. That's been very well documented. And if you look at textual analysis, the same applies. The less information coverage, the more opportunity. Naturally, that opportunity has to be substantially greater than the bid-ask spreads. And you have to be much more careful in terms of portfolio construction and liquidity awareness as you build out your portfolio. But for sure, these are very important considerations.
And if you think about it from like an asset allocation perspective too, for investors that have, they simply can't put another dollar into the S&P 500, which by the way has run to a point in their portfolio where their allocation is already overweight. but they still want to own equities. The question becomes then, where can you go in the world or in terms of an asset allocation to actually get access to something that's going to look and feel different than their core position in their portfolio?
Do you have one more question regarding the NLP? Are there any challenges or shortcomings in this NLP process? Anything you would be able to do?
Okay, so this Computex data set, the value is that you have timestamps with sentence extractions from a variety of different regulatory filings, as well as earning call transcripts, as well as annual reports. And it's grouped on a topic by topic basis. The sentiment analysis is driven by PhD accountants creating rules for what the implication of the text states. So we've tried to push it a little bit further at Bridgeway in our research, and we used different types of LLM techniques to see if there's agreement with what the PhD accountants have actually asserted the sentiment is. Most of the time, there is agreement in terms of applying LLM techniques. There's sometimes disagreement, and I think those instances are most interesting in terms of trying to understand what's going on. We find that a hybrid technique of using rule-based and LLM techniques is very important. What we're also finding, and this is quite interesting for me in terms of understanding like point-in-time LLMs. When you apply an LLM brain, and the LLM brain is taught through 2020, for example, it's going to do much better in its predictive value through 2020 and less so in 2021. So I'm sure you guys have looked at Hugging Face. This is kind of like the website that provides different types of LLM brains, and you see a timestamp of up to what point those LLMs have been trained. And when you look at that data set, and you identify when the LLM was trained, you actually see better predictive value of that LLM through the training period. Basically, in-sample LLM are producing better in-sample results than out-of-sample LLMs. And I think we're going to be talking about this a lot more as we have more time where we're using these LLM type brains. So this is definitely going to be a future challenge. I suspect that we're going to have point-in-time LLM brains in the same way that we have point-in-time data sets for doing systematic quantitative research.
Very interesting. Great. Thank you. Thank you for that insights.
I have her questions in case, I guess, the follow-ups were besides the NLP, is there anything else that excites you in the last couple of years that's being added to the research process or portfolio construction process maybe?
For sure. I think that the classical risk modeling techniques that quantitative methods have been applying is looking at historical data. So in 2020, looking at historical data has really challenged portfolio positioning. COVID introduced a great deal of logistic challenges in terms of trade. Risk models historically have not been trained on that newer data. So risk models I think are very much backward looking. And this is one of the elements that we look at in building out our portfolios. Rather than just looking at history to identify current risks, we're looking at more fluid, more recent daily data and identify risk models based on time varying, very quick moving covariance matrices.
Yes, because currently we are in outlier time. So yes, exactly. No data can see this.
She was trying to get a sense of use of alternative data in the international market. The domestic market feels like it's picked through with the credit card data and things like that, right? But is there more value in public data internationally that's readily available to everybody? So the question is an alternative.
We find that textual analysis for international markets is particularly effective, much more so than the US, especially when using our Computex data set, primarily because there's no other data set that I know of that looks at a topic by topic sentence extraction in emerging markets. What I get most excited about is the coverage amount of this data set in small cap international as well as emerging market companies. So I would see that as an alternative data set that has strong potential in our ability to pick stocks. And our special sauce in the way we are going about this research to add value to the underlying data set is particularly interesting. And I think that's a topic of maybe another hour of conversation.
Right. No, for sure. So just to understand better, and for the listeners to understand, sentiment data would be, -1 to +1, right? It's like you would have to standardize it somehow, right? Would it have to, mega bullish and mega? No, I mean, probably nobody's in -1 completely, but it goes in that range, or A to F, like you mentioned earlier. And then in the investment actually process, let's say you is it just another factor that you're adding, or is it something that's actually like a governor on top of, like, if the numbers are blinking by, or the valuation, whatever, but the sentiment is actually cautious, does it overwhelm it, or is it just like a equal weighted?
So at this point, this is used exclusively for research. It does help and identify externalities to our systematized stock screens, just like a Google search would for us. So this is additive to our externality analysis, but we are not applying this directly in terms of a systematic application. In terms of, Nikola, are you asking about the specific data set now, or are you asking about something more specific? I can give you more details about the data set.
Yeah, no, just in general about sentiment analysis, but I'm sure it relates to the CompuStat data set as well. Just trying to explain Computex in this particular case. Yeah.
Yes.
And just I just, while we were talking, went on the Computex website, and I see Bridgeway Capital Partners is listed as one of the partners, and then I see you actually wrote the paper, the most recent one. You're one of the contributors, right, or authors.
That's correct.
About the next accounting frontier, bringing structure and reliability to NLP, which I will read immediately after this call because it's fascinating. But what is the relationship between you and the CompuStat? Can other people access this data, or is it just,
This is a data set that's available to everybody. I think the specific things we're doing with it at Bridgeway are very much unique to Bridgeway.
Interesting. Zoranka had a question on in portfolio construction. What are the predominant technologies, and has anything changed more recently? She's a machine learning PhD and a head of machine learning, so she always likes to drive it back to the traditional mathematical approaches, not something, not necessarily the LLMs and things like that. But is there anything? Do you use it? Is there how has the use changed?
So I don't want to get into any of the details of our portfolio construction techniques that are proprietary, but let me say that some food for thought here is that in an experiment that I think every quant should run is what happens when you hold your stock preferences constant and you apply like an axioma portfolio construction optimizer, or a Bara optimizer, or a Northfield optimizer. What happens if your stock preferences don't change, and the only thing that you allow is the risk model to influence the portfolio? And here, what we see is 30 to 40% of annualized turnover from the classical 5-year covariance matrix estimated risk model and optimizer is going to be primarily because of changes in risk. At Bridgeway, we want to make sure that our turnover, which is costly, especially in the small cap spaces that we, I think, excel in. We want to make sure that the turnover is used effectively. Our finding, my finding is that using classical off-the-shelf portfolio construction techniques waste turnover on risk controls based on risk models that are very much backward looking. They're not really considering what's happening in the market. Imagine 2020, you're looking at a risk model that was estimated over the past 5 years. Is it really going to help you? Should you be applying turnover based on risk models that could be 5 years old? And our view is no. And we have a proprietary technique of getting at allocating our stock holdings based on what we defined for a hedge fund product as gross exposure proportionality. And for long only, we focus on what we call active share proportionality. I don't want to get into the underlying mathematics, but the point is that we're not as sensitive to historical covariance matrices, and we're trying to identify what's happening in the market now and adjust the portfolio to risks that are affecting the portfolio now, rather than things that happened in the portfolio 5 years ago.
And just for the last one, the topic that keeps coming up with other managers and other portfolio managers and other funds is this notion of explainability. And I think it has to do something with bridging the fundamental people with the quantitative people, because every time in the past, if you told a fundamental manager, whether it's a vendor or somebody comes, hey, we have this black box and he tells you to do this, they would say, but why? And you would have to explain it somehow, right? And I feel like also, as some of these strategies are becoming more mainstream, regular people also, or just consultants also like to ask why. So is that something, discuss how explainability maybe weaves through your process, and has it become more important, and just whatever I'll let it freestyle without.
I think explainability, understanding what our screens are telling us, is overwhelmingly paramount. Let me give you an example in terms of the textual analysis work that we've done. So if you look at about 1.25 million sentences extracted from 35 plus countries, what we see is that right after Liberation Day, across almost every sector in the United States, the sentiment of CEOs, CFOs in earnings calls in the United States has kind of fallen off a cliff relative to 5 years of history. And you contrast that to Asia, where we have as good coverage because of its Computex database. And you see that it hasn't fallen off a cliff after Liberation Day. You see that it's been steady or improving across almost every sector, looking at more than 1 million sentences in just 2025 alone. So when we see alignment in terms of what's happening and what's intuitive and what's easily observed in the marketplace with big data of the kind that I'm describing, it gives us more confidence in applying a data set like this. We haven't applied this textual sentiment analysis directly in our stock screens, but results like this give us more confidence that the data that we're looking at actually makes a lot of sense. We can spend another hour just talking about this. And if you'd like, I'd love to share some of our charts if there's interest, and
For sure.
getting into a deeper dive in terms of this particular data set and the Journal of Portfolio Management publication.
Yeah, no, we'll definitely circle back after the thing. So I know we're pushing on time, and I know there's some other commitments here that were disclosed earlier on time. But listen, this is probably one of the more fascinating. A lot of people like to keep it close to the vest, and we understand completely when it comes to competitive reasons. But the way you lay it out and everything, it's really unique. So
we try to be very transparent in terms of everything that we do at Bridgeway.
Seema knows, like, I always say that asset management is a lot about storytelling, right? And it's the good storytelling that, wins the mandate and actually can explain, back to explainability, a different type of explainability. If you maybe have perhaps a difficult year or something, once you can tell a good story and you stick to it, it matters a lot. And I think it looks like that's one of your fortes. So I would like to, yeah, right, Seema?
Yeah, we're very excited about what we're doing, frankly, and it is very unique in the marketplace. And so, unlike layered large asset management firms, we're happy to be somewhat transparent in what we're doing, and certainly clients receive full transparency around what we're doing. And so, um, it's been a great place for Jacob Strategies to incubate and for us to be able to offer them out to the market.
You definitely seem excited coming from a gigantic place it is a big difference. I experienced similar things, but thank you both again. We will, stay in touch, and this was, again, thank you. This was a wonderful conversation.
Well, thank you for
Thank
having us
you.
on.